Hi, I'm Bill Wilt of Assured Research. Thanks for dialing into this short presentation focused on trends in economic and social inflation, and very specifically, trends in economic inflation and how they percolate through and impact actuarial work. Highly relevant in light of the some of the challenges that, in particular, personal auto insurers are experiencing here in the spring of 2023, and with ongoing adverse development related to economic, mostly economic inflation. If you'll bear with me, I'm going to share my screen and we'll get started. Good, there we go. So we have made this presentation on trends in economic and social inflation. I'm recording this at the end of April, already 3 times this month, with a couple more scheduled in May and June. So it's clearly a topic of interest to insurance professionals and highly relevant. Um, we released this presentation as an assured report, so subscribers will have access to this, all of which is drawn from our assured briefings and our assured researches, both recently and over the years. Um, most of our presentations have had the 4 components that you see here. We're going to focus in this short video on economic inflation. The first bullet point is, I say, how it percolates through insurance claims and into actuarial triangles, and what it can mean for insurers. So economic inflation matters, to say the least. But the good news is, and what we've been showing in our work with data back to the early 1950s, now for a couple of years, is that actuaries have proven adept at monitoring and incorporating changes in economic inflation in their pricing. So they've effectively, and here's a bit of an overstatement, they've effectively neutralized the adverse impact of an upward inflection point, or a spike higher in inflation, through their pricing, and therefore neutralized its adverse impact on underwriting results. Now, that's a bit of an overstatement, because things don't happen simultaneously necessarily. There oftentimes is a lag of a few quarters or up to a year as that data starts to come through, or as just the rate filing process allows companies to build those changes into their rates. And of course, regulators can have an impact, and we're seeing some of the adverse impact of slow regulatory acknowledgments of inflation and approvals of rate filings, and that's particularly affecting personal auto insurers. So it's not to say their track record is perfect, but in the main, insurers do a good job of monitoring trends in economic inflation. It's useful, we think, and to take the CPI as it's reported. Excluding food and energy is very common because of the volatility of those components. And then break that further into its flexible and sticky components. Flexible inflation, which we're not going to focus on here so much, is mostly relevant for first-party property insurance coverages, auto physical damage. These tend to be, or the series incorporates changes in the cost of goods that reprice quickly. Again, you can think of used cars, or you can think of a lot of the raw materials that go into repairing properties that have been damaged by a tornado or a hurricane, or any other insured peril. So good news is that series peaked in early 2022. It's been steadily receding. The bad news is that it's still, again, for personal auto insurers, it's still kind of roiling some insurers, and they're even in this first quarter of 2023 reporting adverse reserve development or higher than expected loss costs because of it. We're going to focus here on the blue line, which is sticky inflation. Sticky inflation you can think of as capturing changes in costs for goods and mostly services that don't change as regularly. And annual is the typical cadence here. You're thinking about medical costs, educational costs, healthcare costs, the cost of legal services, rents, and so forth. Instances where longer term contracts might be signed. It's proving to be aptly named. We've had 7 consecutive readings around 6.5%, and it's this, we'd submit, that is highly relevant for liability insurance claims. And why is that? Well, about half of liability claims are economic or driven by economic costs, measurable costs, like I keep saying medical, wage, legal services. You see medical here is about 25% of the typical liability claim, the other 20, another 25%, and some together about half of liability claims, other economic costs, of which lost wages would be a major component. So if we focus on the trends in those three series, um, what I'd point out to you with in this slide is that prior to the pandemic, those three major components of liability claims were behaving pretty nicely. They were kind of bouncing around between 2 and 4%. And then you see starting in March of 2020, they kind of went haywire with a bias to the upside. And it's that is helping to drive what we early on at the start of the pandemic deemed to be disrupted diagonals. The diagonal, by which we're referring to the diagonal of an actuarial triangle that is so fundamental to reserving and pricing for the cost of goods sold. I'm going to come back to comments on medical, the CPI for medical, which does appear to be decelerating, but that may be a bit of a head fake. In this slide, where we really connect the heart of this short presentation, we connect the liability trends with how it manifests in the actuarial triangle. If you look on the left-hand side, we've gone back longer to the start of this century, weighted the three components together, again, major drivers of liability claims in what seems to be a reasonable fashion. And you observe that a few things with the graph on the left. 4% would have been the answer as to what's kind of the right in air quotes loss cost trend in the years prior to the financial crisis. 4% would have been the answer. Came down with the financial crisis, with in our era of low interest rates and very modest GDP growth. And you had a lot of years where kind of 2 to 3% was the answer to the question of, gee, what's the right liability loss cost trend? Then we move forward in time at the pandemic. Again, you see those trends start to really go haywire and be volatile with a bias to the upside. What's that mean for actuarial work? And that's what the graph on the right shows. What we've done is colored in red those accident years where the loss cost trends on the left were above 4%, and in blue the years where they were below 4%, and a lot of years again in the 2 to 3% range. And what you see there is a big block of blue from 2008 to 2019, where the loss development patterns would be driven by and reflective of this very benign loss cost environment. Actuaries, as many of you will know, use the past to predict the future. So in the absence of making some explicit adjustment for that very benign period, you're going to assume that the immature accident years, call it 2020, 21, and 2022, will develop in the same fashion. But of course, we know from what we just went through and living life for the last few years that the economic environment is much more volatile. Inflation has been very impactful. It's much higher. You see that in red in 2020 and 2021, or excuse me, 2022. So what many actuaries, most actuaries, we surmise are doing is trying to overlay some higher level inflationary development on both the most recent accident years and the open claims along the diagonal. But I will tell you or share with you from our work, what we see when we look at the actuarial triangles is you do see the manifestation of some of the pandemic related disruptions, pandemic and subsequent inflationary pressures. You're beginning to see some of those disruptions in the last couple of diagonals, and that really does drive uncertainty in greater uncertainty in the loss reserving and pricing functions. Very quickly on medical inflation, you saw in the CPI from a couple slides ago that it was going down. We're concerned about medical inflation and maybe are raising the yellow flag here. Why on the left? from a supply demand perspective, we're all aware of the retiring baby boomers, and the size of that generation, and kind of the great resignation and the impact that that's had on, and the pandemic has had on the healthcare profession. Lots of hospitals are in financial trouble. Um, Further adding to the pressure, governmental policies during the pandemic really expanded the ranks of those receiving Medicaid. Um, Not to suggest that it wasn't the right decision at the time, but the outcome has been that we've had tens of millions of additional people receiving Medicaid, where the reimbursement to the hospitals, many of which are losing money, is something like half or even less than private payers. And so that's driving, in the issue on the right hand side there, this risk of rising cost shifting, incentives to shift costs. Now, um, that's been happening for some time. We're simply surmising that the pressures coming through the pandemic have probably accelerated that issue. Um, and what's that mean? Well, we think it could mean higher medical inflation in the years ahead, and it's going to be an area of research focus for us. Here we show, rather than the CPI, which is impacted by some measurement issues and lags, particularly with the measurement of health insurance, if we turn instead to the producer price index, more of a wholesale measure of cost changes. And we look at some important series like inpatient, outpatient, and payments to hospitals. There you see a similar pattern. You see trends that were pretty well behaved in the years before the pandemic have become meaningfully more volatile since the pandemic, and I would submit with a bias to the upside. So that's what we had for you. Thank you for watching this. We're going to be doing more of these videos, and so please feel free to give us feedback. And again, all of this content is from our research, so we'll encourage you to look there for more if we can be helpful. Thanks again. Goodbye now.